Hi everyone, in today's video we're going to discuss chapter 12 of The Intelligent Investor. Things to consider about per share earnings. I'd like to open with a quote by Benjamin Graham himself. Corporate accounting is often very tricky, security analysis can be complicated, stock valuations are really dependable only in exceptional cases. Benjamin Graham opens chapter 12 with two pieces of advice for the investor. Number one, don't take a single year's earnings seriously. Consider the average instead. Number two, you gotta look out for accounting traps in the per share figures. But what kind of traps exactly can be hidden in the financial reports? The first trap that can be hidden in the financial reports is dilution. When the bond issue that are convertible into common stocks are not taken into account in the earnings themselves do not reflect the actual figures. A second trap that can be hidden in the financial reports: special charges. Special charges are expenses that should not be incurred again in the future, at least in theory. When a company financial reports earnings do not take into account special charges or hide them in the footnote, they provide earnings figures that do not reflect the actual ones. Some companies use special charges for expenses that have nothing of extraordinary. This practice may mislead the investor into thinking that the earnings are actually higher than in reality. Number three, income tax deductions. Sometimes a company includes some future expenses in the preceding years. By doing that, the company will benefit from the tax savings from those losses in the future years. Therefore, not only future years' earnings will be free from those expenses, they will also enjoy a favorable tax treatment. Therefore, this kind of practice might be misleading into believing that future earnings are actually higher. Generally, when companies engage in this kind of practice, they do it in a recession year. So basically, they charge as much as possible to the bad year, which had already been written off mentally as a recession year, leaving the way clear for nice figures in the next few years. This practice, of course, can be misleading for an investor and is a thing you need to watch out for. Number four is the way of treating depreciation. Sometimes a company changes the method of treating depreciation, resulting in an increase of earnings that is not real, only on paper. Two investors that have talked a lot about misleading accounting practices are Charlie Munger and Warren Buffett. In particular, during the 2002 and 2003 shareholders meetings, they talked about EBITDA, which means earnings before interest, depreciation, taxes, and amortization. They gave quite a few pointers for the investor and things to watch out for when companies use EBITDA in their financial reports. In particular, Warren Buffett noted that big companies such as Walmart, General Electric, and Microsoft don't use them. Number two, Warren Buffett said that the depreciation not only is a cost, is the worst kind of cost, as money is spent up front and deductions only come later. Warren Buffett also said that taxes are a real cost, and pretending otherwise is delusional. Charlie Munger concluded saying that creative accounting is a curse to civilization. In the 2003 shareholders meeting, Warren Buffett made some sarcastic remarks on the use of footnotes in financial reports. And I quote, "Why not put everything in the footnotes? Then you could have just two lines to report revenue and income." I also want to quote Charlie Munger, who, talking about EBITDA, said, "Everywhere you see EBITDA in some analyst report, simply insert the words bullshit earnings." And I think this tells it all about EBITDA. Okay, so I went over the things to watch out for in the financial reports, but how to look through the fog if the financial reports have plenty of those accounting traps and special charges. Well, a pretty good medicine is just look at the average earnings. And this has a lot of benefits. Number one, if you look at the average earnings, that solves the problem of what to do with special charges and tax credits that you don't know how to allocate because they don't belong to a specific identifiable year. You just include them all because you're looking at the average over a period of years, like 7 or 10 years in the past. Another problem that can be solved by looking at average earnings is that it takes less seriously temporary ups and downs of the business cycle. Okay, now I want to finish this chapter review with a few bonus pointers to read financial reports. Number one, you should read the entire report because often the most important things are hidden in the back because the company doesn't want you to find them. You also should read the notes because often the most important things are hidden in the footnotes. See EBITDA. Finally, read more because if you're an aggressive investor who's dedicating a lot of time to investing, then you should read more about accounting and how corporate reports are built. Here are a few suggestions. Number one, Warren Buffett and Interpretation of Financial Statements. Number two, The Interpretation of Financial Statements by Benjamin Graham himself. Financial Statement Analysis by Martin Frisson and Fernando Alvarez. The Financial Number Game and Financial Shenanigans. Okay, so thank you for watching this video. If you liked the video, don't forget to subscribe, like the video, and watch my other video about finance and the intelligent investor. Bye everyone.